How's it going, everyone? It's Leo here. So as you can see, I'm in a new car that I just bought not too long ago. This is a Dodge Challenger. Got the red leather seats and everything, and don't worry, I got this just for the camera, so I don't gotta like look at it or focus on it too much, so I'm good. So I'm up here in Michigan right now, and real estate's been good. Nah, I'm kidding. Basically, it's just because I'm over working for FCA as a logistics buyer, so they've been paying me well. I could afford buying this car. But real estate actually has been going pretty good. My other property that I have, it hasn't been giving me any issues. I've been getting all my $200 passively each month. So that one, I went into it in the other video that I talked about, so you could check it out there to see like how much I'm making there and how I went about that process. This video, I mainly wanted to touch basis on what lenders are looking for, which is really what you're going to care about, obviously, because if you're looking at this, well, then you're probably looking into like getting possibly a new loan or buying a house or maybe an apartment or just moving out of where you are. This will basically be just a video where like I'll give you everything you need to know for what lenders are looking for. Before I jump in though, I want to throw this out and to like just have it in the video. For my first 100 subscribers, I'm dropping my phone number down in the description if you want to just shoot me a text message or something, or even call me if we could like set it up, and I'll help you out through the process if you need it. I'm only doing this for the first 100 subscribers, so after that I'm just deleting it. But if you're the first 100, you could just always shoot me a text or call me, and then I'll answer and I'll try to help you the best I can. So I know in my last video I talked about options trading a lot, and that's basically just something I was doing in the meantime while I was still like getting my money together to like buy a down payment. Now that I have that all together and I have the job to back me up for the income part of it, the W-2, which I'll go into, well, now it's just, that's my focus. So I'm dropping out of the stock market for now, and then I'll be jumping into real estate real soon. I'm already going through the process for getting a new property. I'm still seeing which one I might be buying. I'm looking for a duplex, triplex, maybe even a fourplex, but I'll see. So yeah, my focus is going to be back on real estate, at least for now. Now, basically, if you want a lender to approve you, you're going to need three things. You're going to need good credit, you're going to need an income, and you're going to need enough money for a down payment. Now, the reason I say a good credit score for this one is because unlike the other two with the down payment and the income, those purely affect just how much will be lent to you. If you have a good credit score, then that's actually going to affect the interest rates you're getting. And without a good credit score, it doesn't even matter what you're looking into. No lender's gonna lend out to you. Now, thankfully, there is something called an FHA loan, which I believe is the Federal Housing Administration, where they look into giving people their first primary residence. So if you don't have a primary residence at the time, you qualify for this loan. And I believe it's in general too, as long as you don't have an FHA already in process. Because the thing is, you can only have one at a time. But with these FHA loans, basically, it's 3% down, and they really help you out throughout the process because it's like a government insured loan where like the bank is gonna give you the loan, but then for some reason, like the FHA is gonna be insuring it. So it basically helps out and it's a bit more secure. Due to this though, it does take a little bit longer for it actually to go through, but it's great because for that reason also, the requirement for the credit score is a bit less. It could be probably in the like high 500s, low 600s, where I'm sure most of you know a decent credit score is going to be above 700 and you'll be fine. But yeah, credit score is really important because that affects your interest, and well, basically that could shave a couple like bucks off your like monthly payments. Now later on in the video, when I get to that point, I'm going to touch on another benefit that the credit is going to have when you're going through this lender process, because basically you could use it to compare rates, but I'll touch on that in a little bit. So now the next portion of getting a lender to approve you will be having an income. Just any sort of income will work. Now for the majority of you watching, I'm going to assume that you have an income from a job. So you have a W-2 statement every year. Now due to that, you should be fine because they get a little bit more picky when it comes to self-employed workers, just because they want to see exactly how much you're making, how you're hiding it, and they want to see at least 2 years of self-employed work. So if you have a W-2, you could probably do it even sooner, but if you're self-employed, it's going to take a bit longer and it's going to be a bit more annoying just to get that through. But if that's not the case, you'll be fine if you're just working under a company with a W-2. So now your income is basically the main factor in determining what you can afford for your loan. So let's say you're making around like $35,000, odds are you'll probably get approved for $150 to maybe $200,000 loan. And then again, that's also taken into account whether you have the down payment or not, and that's basically what I'll talk about next. But in regards to basically how much you're making, well, they'll take into account the full gross income. So it's whatever you're making before taxes takes away their fat chunk, which we've all had to deal with, I'm sure. So yeah, if you're self-employed, you have to take into account basically the pre-tax is what they're gonna look into, and then it's also validating your full 2 years of how much you were making to get a good consensus of how much you will be making more consistently. Because with self-employed, basically you could be making, I don't know, like $1,000 this month, and then $300 next month, and then $2,000 next month, but that's not really a good basis on consistency, which is the biggest thing lenders care about. So if you have a income that's W-2, you're pretty much good to go for this. So income, biggest thing I would say is just, if you have a W-2, you should be fine. Just have some time there and keep in mind like how much you'll be able to afford considering the income you're making. And then a good, let's say, guideline to look at is 33% of whatever you're making is what your payments should be. So if you're making about $3,000 a month, comfortably, they'll easily approve you for about $1,000 a month, because that's what they like to see is 33% for living. So anything above that, they just might budge, but if you're under 33, you should be good to get approved for that. Now, when it comes to down payment, it doesn't really affect how much you can afford for your loan, but it could definitely hurt you. That's the thing, because the more you put down, the lower your monthly payments are going to be, and then the more likely they are to lend to you, since you have majority equity rather than 3%. And let's say if you have 20%, you own more of it, so you're obviously going to pay less for the loan. So typically they'd like to know that you have around 20%. They're not always too picky with it. Like I said, with an FHA, maybe even with a 3% conventional loan. These are for primary though, so keep that in mind. They'll take 3%, but you gotta have everything else pretty good for them to look at 3%. You gotta have good income for that property. It has to be well in your budget, and you have to have a pretty decent credit score for them to do the 3%. But yeah, for down payment, let's say if you're looking at a $100,000 apartment, ideally it would be better if you have $20,000 for the down payment, and then don't even forget about closing costs. Closing costs, let's add about $7,000 or $8,000 conservatively, because my property, I paid around $6,000 just in closing costs, and it was a $75,000 property. So I decided I'm gonna just walk around for a bit and just to wrap up the video. So you know that if you want to get approved by a lender, what you're gonna need is a good credit score. You're gonna need that income. Doesn't have to be good or bad, just a stable income that they could see, preferably a W-2. They could be like, okay, this is how much they're gonna make, so we're gonna take that into account for how much they can afford. And then the down payment is just basically seeing whether you could actually afford that property that your income qualified you for. And they'll take that either with a 3 or 20% into account. Preferably have 20% plus closing costs just to be on the safe side, but if you could try to get that FHA loan, you could bring that down to 3%, which would be the ideal situation for you. So if you could do that, that would be great. And then what I was gonna say about the credit score that you should check into too, is basically when you have a good credit score, you're gonna get good rates. So the lender's gonna say, I don't know, maybe 4%. I've even seen 3% like interest. So if you could get that there at good rates, basically get that, let's say, I don't know, 4.5% from one lender. Let's say Quicken Loans, for example. I use them, so let's say 4.5%, and then take it to another lender where basically at that point, you could just be like, okay, look, I have these 4.5% here. I was gonna go there, but it looked a little bit sketchy, so I'm not gonna do that. I'm just walking around. So let's say you have that 4.5%, then you could just take it to another lender being like, look, I have 4.5%, can you beat that? Then they'll be like, okay, we'll give you 4.25. Then you could just go back to Quicken Loans and be like, look, I have 4.25 now, can you do better than that? Then they'll do 4, and just keep that going back and forth until you can get the best possible rate you can. And you can only do this with a good credit score. So that's why it's super important to have a good credit score. Right now I'm in the process of trying to get another property, so I'm pretty open with anything. If you ever want to ask me, I'll be truthful about it. Currently I'm making around $5,000 a month at my current job. So with that, I'm trying to buy maybe a $300,000 or $400,000 property. between the 1 to 4 unit. Not really one, but a duplex, triplex, or fourplex. So that way I could live in one unit and rent out the other units. So basically what most people would call that is house hacking. Just found a way for that car to pass. So that would be house hacking. So that would be the ideal situation for me, because then I would live there for some time, get that company, and then like later down the road move out and then just keep the process going. And that's really how you build a portfolio there going. So I'll try to keep you up to date on the whole process there. Be sure to subscribe if you got any questions about real estate, or if you just want to learn a little bit about it. I'm your guy. I'm going to post videos about that a lot on my channel. It's been a little bit gone recently because I just moved up to Michigan from Miami, so that was a pretty big transition, but I'll try to keep it rolling again and put these out regularly. All right, thank you. And if you like this video, hit that like button. It'll mean a lot. And then if you have any questions, just drop it down in the comments. All right, well, thank you for watching. Have a good day.